The official cash rate has been dropped by a further 0.5%. What does this mean? And more importantly, what does it tell us about the future trajectory of where mortgage rates will be in the future? Now, it's my firm belief that by understanding the cycles and the trends locally and internationally, and also kind of just understanding when something happens, it has spillover effects in other areas, it can help us to make better decisions around refixing our mortgage rate. Now, of course, you could use what I would call a passive strategy or something akin to interest rate averaging, where you just take your mortgage and you split it up into chunks, and then you just keep on refixing them for different terms, just to hedge your bets a little bit. That way, you don't need to worry about what's happening in the big wide world. As long as you know what's going on in your world, that's fine. And that's a totally valid strategy. But often, a lot of people start off like that and they can't resist the temptation to think about what's happening in the world and how it does affect their mortgage. And so I'm more of an advocate of the active refixing strategy, which involves a consideration of what's happening in your own personal world, overlaid with a consideration of what's happening in the big wide world that you can't control. So let's get stuck into this one. What are some of the things that I would be thinking about right now if I was refixing my mortgage? Well, there are four things that I would consider. Firstly, the R word, recession. Depending on how reliable the data is, by the time it filters through to those actually making decisions on interest rates, the New Zealand economy has been banging on the door of recession for over a year now. And the issue is that the data that comes through, things like the inflation rate or the unemployment rate, or even the GDP rate, or that just means how much the economy is producing in a year. On the ground, though, from where I sit, doesn't matter what the acronym is, talking to families where both parents are working, they're really struggling. Businesses, a lot of business owners, small to medium sized enterprises, they're having to shut down or they're having to scale down. And things are super tough out there. My personal belief is that the recession that's occurring in New Zealand is actually way worse than what the data suggests. Not for everybody, and thankfully not for everybody. But unfortunately, those in, say, poorer households, but increasingly in the middle class, they're really struggling. And it's no surprise either, because this was actually all on purpose. Now, I know it sounds a little bit conspiratorial to suggest that, so let me back that up with some actual quotes. So, regardless of the fact that government and central bank got us into this position, they actually engineered a recession as well in order to help get us out of this position. Now, here's a quote from Adrian Orr in late 2022. The bank was deliberately engineering a recession to bring down inflation. He further explained that this was necessary to squeeze a horrible environment of pernicious and persistent inflation. If only they could be that honest around where the inflation came from in the first place. But let me know in the comments where you think it came from. Now, what does this actually mean, though, for you and me? Well, it means that interest rates that you can pay right now for each of the different periods of time that you can fix your mortgage for, from 6 months all the way up to 5 years, well, it means that it already factors in all of the known information out there. So it factors in the rate of inflation, it factors in the rate of GDP growth or decline, it factors in the rate of unemployment and how bad that is getting. So we call this the efficient market hypothesis whenever we talk about how information is already factored in and it influences the price, whether it's an investment or it's an interest rate. And you can't outsmart the market. So you can't look at the interest rates over the different periods of time and infer from that what a very clever strategy will be, because the fact that interest rates get cheaper the longer you fix it for right now means that the market does believe that interest rates will fall over that period of time. So you need to go a little bit deeper and occasionally be willing to be a contrarian thinker. Now, in this case, my view at the moment is that given the recession feels a lot deeper than what most policymakers, including the RBNZ, currently appreciate, interest rates may have to drop a little bit further and get there faster than what we thought even just a few months back. What does that all mean? It means that probably over the next 3 to 6 months, especially, we could see interest rates dropping quite quickly. Now, secondly, let's talk about geopolitics. So, geography, politics, marry those bad boys together, geopolitics. Effectively, what's going on in the world of narcissistic leaders out there in the world. Well, there's a growing war in the Middle East with Iran and Israel, with NATO and Russia, and with the US and China. It will potentially get worse before it gets better, at least until January, when a change in the US presidency could occur. And so it's really important here, I think, just to think about that when major wars emerge, there's often a parallel economic or financial battle that's actually happening at the same time. Historically, to finance warfare, states would issue bonds. Effectively, they're passing the hat around, soliciting for public funds to go towards this effort. But over time, as public support for war waned, as people just thought, I'm not going to fight for that, I'm not going to support that, the governments innovated. And they found that through their partnership with central banks, they could fund the war using new methods. Now, they effectively issue bonds that central banks purchase instead, which allows governments to essentially print money through complicated shell games that everyday people really don't understand or care about. And this process, through inflating the currency, devalues the existing money that's out there in circulation, which is effectively like a tax on all holders of that currency. And the reason why this is occurring is so that the government can effectively decide what needs to be spent on that the economy can produce, reallocating resource to the war machine. The main thing to point out here is that what happens as a result is just more inflation. Because inflation occurs when there's too much money chasing too few goods and services that the economy can produce. It's what we saw following the March 2020 event, and it's what we'll likely see should things deteriorate to the point where we're officially in a world war. Now, let's hope and pray that it never gets that far, because if it does, the fact that the only cure for higher inflation is higher interest rates could be the least of our concerns. So, another factor that I would be looking at right now to determine where interest rates might be going is actually the price of gold. What does it have to do with your mortgage? Well, gold has been used as money for not only hundreds of years, but thousands of years. Many investors consider gold a waste of time because it doesn't produce any return. That's like the common criticism that I hear all the time. Much like one might consider Bitcoin a bit of a waste of time or a speculative bet, because it only really has value if someone else is willing to pay more for it in the future. And because of that, gold is often placed in the investment category for the fringe minority, those strange gold bugs out there that like to stroke their metal and smoke a cigar on their leather couch, right? But at the time of recording, the price of gold is actually at all-time highs. We're sitting at around 2,700 US dollars almost, or around $4,500 per ounce. So, what is the price of gold saying right now? Well, perhaps it's saying that investors don't actually have confidence that central banks have the inflation problem under control. It could also be saying that things are still likely to get worse before it gets better, specifically from a geopolitical point of view. Interestingly, bond yields on the longer term rates are also saying this. Now, the Reserve Bank of New Zealand, or the RBNZ, or the US Fed, the United States equivalent of the RBNZ, might be indicating that lower interest rates are justifiable right now. But it's also true that the higher interest rates stay for like a longer period of time, the more likely bank failures or other systemic risks are going to start cropping up and causing problems. Just think about it in your own household. You can absorb higher costs for a short period of time, but the longer those higher costs persist, the more likely you're going to make some serious calls to deal with those risks, like selling a rental property or selling your home and downgrading or even going renting because you just can't afford those mortgage payments. Well, think about that now at a much larger scale. That's what is occurring right now everywhere. The higher interest rates get and the longer they stay there, the more problems they cause, which will ultimately force central banks to create a justification to drop interest rates, even though there are risks present in doing so. Now, before I share the last influence that I would be keeping an eye on right now, remember that if you're fixing your mortgage, The art is to make sure that you're not fixing for too long for your own circumstances or too short for the world that we're entering into. Any good financial decision involves a careful consideration of your own micro universe overlaid with an understanding of the macro world that you're living in. For example, you wouldn't want to fix your mortgage for 12 months right now if you were going to sell your home in 6 months. And why? Well, because if you're breaking out of a fixed rate mortgage, in other words, if you're repaying it before that fixed rate expires, you will be charged what's known as a break fee. This break fee is when the bank is recovering the costs that they've had to carry as a result of you changing your mind and repaying your mortgage early. So if interest rates have dropped since you refixed your mortgage, this break fee can actually be massive, like thousands and thousands of dollars. On the other hand, you don't want to fix for too short of a period either. And so, if all of the signs are pointing to significantly higher rates at some stage to come, then you need to be really careful because when that mortgage expires, you'll be left exposed, and all of a sudden, your biggest expense have just gone through the roof. And we saw that a lot over the last 3 years, especially. Now, with all that said, let me share the final factor and then cover off what we're doing at home personally. So, 1970s, that's the last thing that I would be thinking about. And I'm not thinking about the cars, the music, or the excessive use of orange and brown and corduroy pants. I'm thinking about the relationship between inflation and interest rates and how policymakers occasionally get it wrong. Check out this chart here of inflation from 1966 to 1982, overlaid with a chart of 2014 to the present time. As you can see, the two line up remarkably well so far, don't they? History may not repeat, but it definitely does rhyme. So, what happened in 1971? Well, in 1971, Richard Nixon took the US dollar fully off the gold standard. There was also a nasty but short war in the Middle East. It was followed by an oil crisis. There was inflation. There was higher interest rates to deal with the inflation. Inflation then came down, and then inflation took off again with a vengeance, followed by significantly higher interest rates. Meanwhile, the price of gold and silver went to the moon. Now, today's better in so many ways from the 1970s, of course, but in other ways, it's just the same. The question is, will interest rates stay low because inflation is starting to fall? Or will eventually interest rates have to go higher because more inflation reappears, just like it did in the late 70s? So that brings us to the end of this one. And here's what we're doing at home. We have a mortgage that came off of its fixed rate about a month or so back. And I decided in this case, it's probably better to wait for a bit and not to refix the interest rate on that mortgage at all. Why? Well, firstly, I could see probably around the start of September that the official cash rate needed to fall faster than what the Reserve Bank was on track for reducing it by due to the recession issue, which looked and felt much worse than what was being reported. My thinking is that as much as another 0.5% will need to come off of the official cash rate between now and maybe even the end of this year. And I would expect to see somewhere between 0.5% to 1% come off of all fixed mortgage rate terms between now and probably around March next year, potentially even more. Now, I could fix my mortgage right now for 6 months as an alternative strategy, but I'd prefer to be nimble right now, considering things are actually really dynamic overseas. So I'm watching geopolitics, I'm watching the price of gold, and I'm watching bond yields too. Sometime next year, my strategy will be to pivot from short term fixed rates or from being on a floating rate to potentially fix for a longer period of time from 2 years, maybe even all the way up to 5 years, because I do believe that inflation could be reignited. Now, obviously, I'm not married to any one perspective or idea here. It's really, really hard to see beyond 1 month at a time at the moment. But considering that we're not selling or repaying any large amount of our fixed rate mortgages over the next few years, I'm willing to fix for longer to ensure that I'm managing the risks of rising costs more than speculating on falling rates. Now, in your case, of course, you have to do what's right for you. After considering your own circumstances first, then zoom out and look at the big picture. A strategy like interest rate averaging, like I mentioned at the start, where you need not concern yourself with all these macro things like I've been talking about here, it's a very valid path to go down. But I still believe it's possible to line up your refixed terms to the cycles present in our economy. And if you'd like to chat further around how I work in this space or to request a copy of the latest mortgage strategy report that I update monthly, just click on the link in the notes to subscribe to the newsletter. That's it for this one, though, and thank you for watching.